The biggest trade war in over a century has the stock market deep in the red. And while a lot of the media wants to scare you, I want to show you how to profit from this environment. This is a huge opportunity that investors should be excited about, not scared of. And in this video, I'm going to uncover my secret process for making a lot of money when there's stock market turmoil. And at the end, I'll show you how I'm implementing that process today. I've used a three-step process to make a 266% return in Mexico, 53% in Brazil, 120% in India, and I've been fine-tuning it for over 15 years, so there are a lot of examples, and I want to bring you along for the next one. To show you how it's done, I'm going to take you step by step through my process using a recent example of how I made about a 40% return in 4 months by investing in a 3x leveraged regional bank ETF. Then I'll show you why I think the current crisis in April 2025 is such a great opportunity and what I'm buying to take advantage of it. This is not an exact science and it's not guaranteed to work every time, but it has worked for me almost every time, and it's made me a lot of money over the years. So I'm excited to teach you how to do it. It starts with some market turmoil. Now, that's obviously being driven by a massive trade war, but in our example, it was a banking crisis. The first domino that fell was Silvergate Bank on March 8th, 2023. But honestly, no one was really worried at that point. Everybody thought, well, Silvergate was tied up in the whole FTX cryptocurrency mess, and that doesn't really apply to other banks. But then just 2 days later, Silicon Valley Bank collapsed. Then 2 days after that, Signature Bank collapsed. And that quickly changed the narrative to, oh my God, we're heading into another 2008-style banking crisis. Silicon Valley Bank went down on Friday, Signature Bank went down on Sunday, and by Monday, the ETF had fallen almost 60% in 3 days. I'd never heard of DPST at that point, but identifying market turmoil like that is step one. That tells me there's an opportunity. Obviously, as I'm filming this on April 5th, 2025, there's definitely market turmoil. Step two is figuring out if there's a way to invest in that opportunity and whether I actually want to. The number one thing I look for to determine if I'm going to be interested is how likely are things to get better over the next few years. The short term will always be really uncertain at times like these, but the long term is often a lot clearer. Oil prices in 2020, for example, they went negative. Do you really think oil producers were just going to pay you to take their oil from them forever? Of course not. It's not usually that easy, but in the case of regional banks, it was fairly easy to diagnose the problems of the ones that had failed and determine if other banks had the same issues. There were three key issues in this case. One, the issues that plagued the original banks that failed did not apply to most regional banks. Two, the government showed their willingness to step in and save them, having learned a few lessons from 2008. And three, the banks were being priced like they were all going to go bankrupt. But, of course, I didn't think that they were. To sum it up in a single sentence, the banks were priced like they were all going to go bankrupt, but I was highly confident they were not all going to go bankrupt. But there lies the opportunity. Okay, so step one, market turmoil. Step two, confidence that it's going to get better in the long run and people's short-term fears are overblown. And do I have that confidence today? Yes. That's why I think it's such a great opportunity and I'm making this video. I'll be taking you through more specifics on how and when I think the market will recover and how I'm investing in this at the end. But for now, let's move on to step three. Step three is how to go about investing in the recovery. Not just what you'll invest in, but when and how much. Those parts are key. I do not like buying individual stocks in these scenarios. Here's why. There were other banks that had issues, and no one really saw this coming. So who's to say it couldn't happen to another bank? Why risk losing all your money if you pick the wrong one? With a regional bank ETF, all you had to do was be right that they weren't all going to go bankrupt. An ETF gives you about the same upside potential as an individual stock, or maybe more with a leveraged ETF, and almost no chance of losing all you buy. Higher odds of making money, higher odds of making more money, and almost no chance of losing all your money. It's the smart way to go, in my opinion. It's the same in the 2025 trade war. Individual companies can be targeted, and it's impossible to predict which one might be. Maybe somebody loses access to a component that's crucial to their business and collapses. I don't know, but to me, it's not worth the risk. So for me, the most direct way I can invest in the recovery, other than buying individual stocks, is the way I usually go. Generally, that's ETFs, and if there's a leveraged ETF, even better in my opinion. They're not for everybody, but for me, that's what I prefer. But the other part of how to invest is the size and timing of your trades. This is very important, especially if you're using leveraged ETFs like I do. We're talking about very aggressive investments in times of great uncertainty. It's impossible to consistently call the bottom in times like these. So I will always start small. I think about it this way. What is the maximum I'd be willing to invest in this? Or put differently, what's the maximum I'd be willing to lose if I get it wrong? Divide that by 6, and that's your starting investment. Again, there's no magical science to this, but this is how I usually go about it. Why 6? Because I want to leave room to double my investment twice. If it keeps going down a lot, then my long-term thesis remains intact. Imagine you're willing to invest $6. If you start with $1, then it goes down 20%, you can invest another $2. If that goes down another 20%, you can invest $3. At that point, you've invested $6, the amount you're willing to lose. I do it this way because then, mathematically, I will break even when the stock is still down 27% from my first purchase price. That's how it works in theory, but like Mike Tyson said, everyone has a plan until they get punched in the face. So let's go through a real-life example of how I implemented this in practice, and it did get metaphorically punched in the face along the way. And I'll show you why, inevitably, these situations involve tough judgments that are hard to get perfectly right. As you navigate the 2025 trade war or any future market turmoil with this strategy, you'll likely face similar mental dilemmas, so hopefully this section will help prepare you for that. Here's the timeline of my thought process and my actions. On Friday, March 10th, Silicon Valley Bank went bust, regional banks sold off, and I started doing research. Saturday, March 11th, we put out a video on it saying there was a risk of more bank failures, but it was very different from 2008. Lo and behold, the next day another bank failed. That Monday, March 13th, regional bank stocks were way down. Details started coming out about how the crisis could have been much worse if the Fed hadn't stepped in to save a bunch of banks that would have failed over the weekend. So one went down, but it could have been more like 10. Over the course of that week, regional bank stocks were all over the place. I digested the information. Kyle and I put out videos explaining what was happening and what we were thinking along the way. These were very uncertain times, but eventually I made it through step 2 and decided it was a good opportunity that I was interested in, and I invested. On Friday, March 17th, I decided to take a small starter position in DPST, the 3X Regional Banks ETF. This is probably a good time to mention how the strategy attempts to curb the harmful emotions that get in the way of good investment decisions, greed and fear. It helps with fear because you know you'll never invest more money than you decided you were willing to lose. It helps with greed because it forces you to start small. Could you make more money if you bet the farm on it right away? The timing is perfect? Sure, but timing will always be perfect. I look at it this way. If my timing is great on my first purchase and it goes up 50% right away, but only I'm falling out of money, that's a win. I made a risky investment and I got the timing perfect. I'm happy. I don't let myself go down the, oh man, if only I'd invested more road, because you know what? The timing was lucky. And I won't get it right every time. And if it isn't right, I'll be really happy I didn't invest it all up front. As it turns out, in this case, my timing was not right. The fear continued to spread. Credit Suisse, a large European bank, ended up having to be bailed out by UBS, and then people started to worry about Deutsche Bank in Germany. No one really worried about European banks again after that, but I'm telling you this because there are all kinds of pieces of information that get thrown at you in times like this, and you never know what will end up being relevant in the end. You just have to consider it all. On April 3rd, we put out a video showing that we'd finally gotten some positive news. The regional bank deposits had shown signs of recovery. At this point, DPST was down about 10 or 15% from where I bought it, and a few people asked me if I was thinking about adding it. I did think about it, but ultimately decided not to, because I didn't think the banks were out of the woods yet, and a 10-15% drop in a 3x levered ETF during times of turmoil is nothing. My general rule of thumb for these kinds of investments is that they have to be down at least 20% from my prior purchase for me to buy more. Also, I know I said this before, but I'll reiterate, the original investment thesis has to remain intact. And in this case, it was. I still fully believe that an eventual recovery was likely, and not all the regional banks are going to fail. But it hadn't fallen enough yet for me to add again. It was basically one good day away from me breaking even until it wasn't. On May 1st, First Republic Bank failed, and all the regional banks sold off significantly. Then on May 2nd, we put out another video explaining why the largest bank collapse since 2008 was the opportunity I had been waiting for. All along, I knew it was a very real possibility, that another bank would fail and DPSD would go down more. That's why I started small. But still, First Republic shared many of the same issues that the other banks had, but failed. So it really didn't change my opinion that most of them were still going to survive. At this point, I was down around 30 to 40% for my initial purchase, which, by the way, I had broadcasted all over the internet, so that was fun. But I told myself to stick to the process. You know how I said the process involved doubling my investment each time? Well, I chickened out and invested the same amount the second time as the first time. I even explained in our video how the best time to buy often feels the worst, but I still felt like there was a lot more short term downside potential. Like I said, these times are really uncertain. Over the next 2 days, I lost about another 25%. When did I say usually buy more? When it goes down 20%. Did I buy more? Nope. I chickened out again. You really can't call the bottom very consistently. Once in a while, you can, but I can't stress enough how dire the situation of the regional banks felt at that moment. Kind of like the market feels on April 5th, 2025. News reports were swirling about other banks being on the verge of collapse, and the ETF had just fallen about 50% in 2 weeks after already being down a time before that. So, how do you know where the bottom is? The answer is you don't. Hindsight is always 2020, and looking back now, my May 2nd purchase date doesn't look so bad. It was a few days away from the bottom. Even my original March 17th purchase date was in the green. And I sold pretty much right at the top on July 26th. And where is it today? Down around 40% since I sold it. Selling was a hard decision. You'll always wonder if there could be a lot more upside. And just like it's hard to catch the bottom, it's also hard to catch the top. What caused me to sell was that banks make money by borrowing at low rates in the short term and lending at higher rates in the long term. Usually those short-term borrowings mostly consist of checking and savings account deposits that they pay you next to nothing on. Well, those banks had lost a lot of those deposits, and while the government stepped in to save them, the money that they borrowed from government to replace those cheap deposits was at short-term market interest rates, more like 5%. So they were way more expensive. And how much could they lend out money for in the long term on the car loan or mortgage? Not much more than 5%. So the regional banks survived, but their profitability had come down a lot. That got us to a point in late July where even though their stock prices hadn't come back nearly to where they were, their valuations had reached pre-crisis highs. By valuations, I mean price to earnings or PE ratio. The price was down, but so were their earnings. That meant valuations had fully recovered to where they were before Silicon Valley Bank collapsed, but now we had greater known risks and a looming potential recession. No thanks. I'll take the win. I usually like to hold things for at least a year because I hate paying extra taxes on my gains, but in this case, it just no longer felt like an attractive investment, so I decided to sell. It's different every time, and like you saw, the process isn't an exact science, and it involves constant, difficult judgments along the way. But the good news is that if you follow this process, you don't have to be perfect. I had tons of success with this process on oil prices, Brazil, Mexico, India, US small caps, industrial stocks, inverse VIX, and I've made videos about a lot of them. For most people, most of the time, I'm a much bigger advocate of staying diversified, thinking long term, and not trying to time the market. But I do this myself, and it usually makes me a lot of money, so I wanted to share my wisdom with you so you can use this in the future if you're willing to take the risk. Here's how I'm acting on the strategy this week and what I plan to do going forward. Step 1. Is there market turmoil? Oh yeah, lots of it. The Nasdaq is already in a bear market, meaning it's down over 20% from its peak, and the S&P is close to that, down 17%. Step 2, can I invest in this, and do I want to? Yes and yes. How? There are many ways, since this case is more broad than regional banks, and I'll get into the specifics in a moment, but since this is a broad market sell-off, I need to have an opinion about a broad market recovery. The market is worried about tariffs, and for good reason. The recently announced tariffs will devastate the economy as they stay on. And Trump is probably going to announce even more next week. The market could go down way more than it has so far. But ultimately, if you understand Trump's negotiating strategy and what his priorities are, the potential for a recovery in the coming months gets a lot clearer. Let's start with his priorities. He wants to pass a big tax cut bill, probably this summer. He wants to end the war in Ukraine. He wants the Republicans to win midterm elections in 2026. And let's think about his tactics. Some of the key tactics he lays out in his book, The Art of the Deal, are to use leverage, start big, and ultimately deliver the goods. So let's think about this. Some Republicans don't like the massive debt increase that would come with the tax cut bill he wants to pass. How can you generate revenue projections to possibly make them happy? Project a massive amount of tariff revenue. How would the market react if he did start focusing a lot more on passing a tax bill and a lot less on tariffs in the next couple months? Probably pretty well. The market doesn't like tariffs, but it loves lower taxes. Even if he can't get the full permanent version passed, there's a very good chance he'll get some version passed by the end of the year. And what matters more than the details is that the media narrative will be shifting from negative to positive in the next couple months. Then, let's think about the war in Ukraine. China has been helping out Russia, but China and Russia really aren't that good at France, and China might be able to use a distancing for Russia as a bargaining chip in trade negotiations. Or, probably more likely, Europe or other allies might be willing to use distancing themselves from China as a bargaining chip. But ultimately, Trump's process is to use leverage and start big, but to eventually deliver the goods, which in this case means getting the deal done, saying he's not wins to promote to his base. Then he'll have to do that if he wants to win the midterm elections. He'll need the support of his base, and a lot of them voted for him in part because they were frustrated with high inflation. Well, we're about to get a giant dose of inflation if these tariffs stay on, so his popularity will be falling rapidly. So let's recap. Could the market downturn get significantly worse if the tariffs stay on and there's more escalation, blah, blah, blah? Yes. I want to discount that possibility. But in my opinion, the most likely scenario is actually that it gets worse for maybe the next few weeks, maybe the next few months, as countries retaliate and Trump escalates. But ultimately, I think that the recovery is likely to begin by the summer, not before that. Because while the market is focused on tariffs now, and there might be more to come, and then companies will start cutting earnings and consumers will start cutting spending, and there could be a lot more negative headlines in the short term. Ultimately, I see a lot of signs of a likely recovery not so far ahead. A few months from now, the headlines are much more likely to contain things like trade deals instead of a trade war, tariffs falling instead of tariffs rising, and tax cuts instead of price hikes. Those are likely to be good for the market. And while I do think there will be more downside from here, I've already started buying because ultimately I know I can't reliably predict the bottom. I think the market is attracting from here on a multi-year basis, and I'm confident that my process can generate strong returns in this environment because it has many, many times before with an incredibly high rate of success. There's no guarantee it'll work this time, but then again, that's why I don't invest more than I'm willing to lose. So you might be wondering, what am I buying? Well, I actually made 4 purchases on Wednesday, and I'm keeping 3 of them exclusive to the Fundamentals of Finance Academy members, but I'll share one with you. TNA is a 3x US small cap ETF, which I first started buying during the downturn in 2020. I made a lot of money on it then. And I've bought and sold it at various times through the years after that, but I haven't been this excited about it since 2020. So why small caps? Well, one, small caps were already really attractively valued relative to large caps, even entering the year. They got hurt more than large caps by rising rates, and the market has been mainly driven by the Mag 7 and the AI trade the last couple years, aka only the largest companies. But small caps are also the most vulnerable in a recession, which is why you can see they've been selling off a lot over the last couple months. But small caps actually did really well in Trump's first term, and I don't think he wants to cause a 4-year recession and go down as the worst president in history. If the economy recovers, small caps are likely to recover. When its small caps recover, TNA will likely recover a lot. Even just getting back to where it was in late February would be about a 100% return from here. So I'd bought on April 3rd and didn't add on Friday because, you guessed it, look on the upper left. It wasn't down enough. Remember the 20% rule? I really wanted to buy more, but I stopped myself because the market absolutely could get much worse from here. But even if it does, I'm confident that there will be a recovery. TNA will do extraordinarily well in my recovery, and my process will help me generate a strong return, even if my timing isn't great, like it wasn't with DPST. If you found this video helpful, hit those like and subscribe buttons. And if you want to become an Academy member for access to my trades in real time, my model portfolios, bi-weekly calls, and access to a community of people who are committed to becoming better investors, we'll leave a link in the description below.